Pennsylvania Tax Update. The Budget, Legislation, and Sales Tax Refunds was a live webinar that was originally produced on Thursday, July 21st, 2016. The presenters for this presentation were Mike Eby and Lindsay Waltmeyer, both with McConley and Asbury. Enjoy this webinar recap and visit us online at www.macpas.com for more information about our future events and presentations.
The first item there, we're going to go over the fiscal year 16-17 state budget for Pennsylvania. I think obviously that's the main topic we'll be talking about today, and one that most of you are interested in. Specifically, we're going to talk about what taxes are at play in this year's budget. And then we'll move on to highlights of key Pennsylvania tax legislation that's been passed and is pending or coming up, and then pertinent cases and Department of Revenue publications. Some significant things definitely occurred in the realm of case law the past 6 months, particularly some very taxpayer-friendly decisions that come on the court. So there might be a few businesses on here that might be able to take advantage of some of these taxpayer-friendly cases that have come down. Then we're into the third item there. How does Pennsylvania tax structure compare to other states? The Tax Foundation puts out a report annually of how states compare with their taxing structures to other states and where they generate their revenue from. And the May was the last report that was issued, and I think this will be a very interesting topic to talk about of how, first of all, how does Pennsylvania, what sources are they getting their revenue from, and then secondly, how does that structure and that compare to actually other states? And then lastly, as I mentioned, I want to talk a little bit about sales and use tax savings opportunities that many businesses have been taking advantage of, and ones that might be available for your business. So before we get into the enacted budget, let's first start by discussing the governor's proposed budget from back in February. And you know, Lindsay, last year at this time we did a July webinar update on the same subject, hoping to talk about the budget. It's a little different story at that point. It was the governor's first proposed budget at that point, and he threw everything onto the table as it related to taxes, tax reform and tax expansion. And at that time, it was probably around mid-July, and neither side was really talking to each other, and it didn't look like a budget was going to pass anytime soon. And it definitely didn't look like any of the tax measures were going to pass. And it turns out that's exactly what happened. None of the tax measures passed, and it took about 9 months for that budget to come through. So a little different story this year.
Yeah, I remember that you were sweating a little bit trying to get a presentation together with no material from the PA budget.
Yeah, we had a little filler in there last year. We're going to have the opposite problem this year. We're going to try to get a lot of subjects into a small time frame, so we're going to keep going through this. But it certainly does make my job a little easier on this webinar this year that we have a budget. The governor proposed a much more modest budget this time around as it related to tax revisions. And I would say it was passed somewhat timely. It was a couple weeks late, but again, I would say that's relatively timely passed considering how long it took last year. I think we contribute a lot of that to this being an election year. I think the general consensus going into the budget season was that it was going to pass relatively quickly. I actually heard someone else mention that they thought one of the reasons that it passed within the first couple of weeks is that the DNC convention is next week in Philadelphia, with the national spotlight obviously being on Pennsylvania, and having a late budget would probably have not looked so good. So that definitely gave another motivation factor to the budget probably passing on time. But last year, many government contractors, nonprofits, and some other state funding organizations were just really significantly hurt by the budget impasse last year. Primarily, they're just not getting paid, or they weren't getting, a lot of organizations who depend on the Educational Improvement Tax Credit Program, they weren't getting funding donations from those programs and other tax credit programs. So when those organizations started hurting, they definitely picked up the phone and called their local representative. And so in turn, it really hurt both sides of the aisle last year, and I think that brought a determination from both sides, the governor and the legislature, to make sure the budget was relatively timely passed this year. We look at the proposal from the budget here. If we look at the actual numbers, last year on the left side there, fiscal year 2015-16, the actual passed budget was $78.6 billion. That might seem high because you're hearing numbers that usually reflect what the general fund budget is. That's where a lot of the debate usually occurs, and where numbers can be debated. But there's actually a couple other components to the budget. One's the federal funds, which last year was $27.9 billion, and then other funds, which is made up of motor license fund, the lottery fund, tobacco settlement fund, and the property tax relief fund. So the budget itself is actually much bigger than what is often discussed. And then if you look at the budget this year, what the governor had proposed back in February, in the right side there, it was pretty aggressive spending budget again. If you look at the general fund, it was up about $2.8 billion, which represented a 9.4% increase. So with this being primarily a tax update, we want to concentrate on the revenue side of the budget, which would have obviously the tax initiatives and tax measures in that. So what was the governor proposing back in February?
So if we look at the proposed ones, I like to compare a little bit to the 2015 proposals. For personal income tax, in 2015, the original proposal was 3.7%. It was hard to keep up last year with all of the proposed changes during the appeal process. The proposed personal income tax rate kept dropping, but eventually the enacted rate for 2015 remained at 3.07%, which is what it has been for the last several years. This year, the governor is proposing an increase from 3.07 to a 3.4% personal income tax rate.
Yeah, and Lindsay, it just never was going to happen. A lot of the negotiations that occurred leading up to when the budget was passed, personal income tax just really wasn't on the table. It is an interesting fact, though, that every 0.1% increase in the personal income tax rate would generate approximately $410 million. So it is quite an easy way to bridge a budget gap, but passing a tax increase on essentially the entire population or most of the population of Pennsylvania is not always a good political move, and that really was why it wasn't on the table.
And if we look at the sales and use tax base expansion, here's where the governor was much more modest than in 2015. In 2015, he proposed expanding the base by 45 items, which included legal and accounting services, waste collection, home health care, candy and gum, non-prescription drugs, newspapers, transportation services, and the list goes on. This year, he was much more modest with it, suggesting a sales and use tax base expansion to cable TV, movie theater tickets, and digital downloads. So going down on the list then, the vendor discount for sales and use tax, he proposed a cap on that, as well as a natural gas tax of 6.5%, whereas last year it was a 5% proposal. If we look at the bank shares tax, last year in 2015, the proposal was an increase by 1/10%, so he's looking at the same proposal again this year, and promotional plays at casinos at 8% tax. Finally, if we look at insurance premiums, that's property, fire, and casualty, an increase of 0.5% was proposed. And then a cigarette tax increase, which is generally considered one of the sin taxes and always seems to find its way onto these proposals and onto the budget. He proposed an increase from $1.60 a pack to a full dollar increase of $2.60 per pack, as well as additional taxes on cigars, loose tobacco, all of those types of things.
So now the fun part, we're moving into the enacted budgets. And this became effective at midnight on July 12th. Actually, it was July 11th into July 12th, but and that it became enacted without the governor's signature, and that was intentional on his part. He obviously he was agreeing with the spending portion of the budget, but without the revenue piece, it wasn't a balanced budget at that point. So he wasn't necessarily one putting his name behind that until the legislature provided a passed revenue section. So Senate Bill 1073 was the budget. Final spending amount for the general fund was $31.63 billion. So it's about $1.2 billion less than the governor's proposed budget in February, but actually a $1.6 billion increase from last year's passed budget. So that represents about a 5% increase in the general fund.
So then if we look at sales tax on digital downloads, that is the only part of that base expansion that was passed.
Yeah, digital downloads represented $47 million of the revenue. Digital downloads applies to purchases of satellite radio services, movies, so think Netflix, books, games, and other applications. Really anything that has an application that's being sent to a user with a billing address in Pennsylvania. And really this makes some extent, or makes sense, I should say, because if you were to buy the tangible versions of these products, whether it's a DVD or a paperback book, you'd be paying tax on that. So in a kind of a digital age that we're in now, buying the digital products or having tax assessed on those digital products makes sense. And I just want to take a step back. Obviously, we talked about the personal income tax increase. It just wasn't on the table, so we crossed that out. The revenue piece, that overall, to be able to balance this budget, there was a deficit of $1.3 billion. $750 million of that was through reoccurring taxes, while the other $534 was through one-time measures, including some intergovernment loans and transfers. And of course, the Liquor Modernization Act, which was Act 39, that passed earlier this year. The cap on the vendor discount for sales and use tax, this was actually generating $55.5 million for this coming fiscal year. Really what the vendor discount is, it's compensation for administrative costs and handling a trust fund tax for Pennsylvania. Basically, the retailers are charging tax to their customers on the products they sell. They collect the tax. It's not really the retailer's tax ever, but they're then remitting, they're kind of a vessel then just to remit it to Pennsylvania. Now, Pennsylvania is giving 1% of the tax collected back to the retailer if the returns are timely filed. This is kind of low-hanging fruit for the legislature. This has been on the table several past budgets to limit this cap. In fact, only a dozen other states have some type of vendor discount on the books. So the vendor discount's not going away completely, but for medium to large companies, it's essentially going away to a major extent. Right now, the maximum will be $300 a year, and it's by return, so $25 monthly, $75 quarterly, and $150 semi-annually. And the reason behind this is because the logic is that medium to larger businesses can handle the administrative burden associated with collecting a tax, so they really don't need the, quote, vendor discount. But it can make a big difference for medium to large businesses, right,
Yeah,
Lindsay?
definitely. If you take an example of a retailer or any corporation with annual sales of $1 billion, that comes to $60 million in PA tax at 6%. That would previously be a discount of $600,000 for that company. Now that is limited to just $300.
Yeah, big difference. Obviously, we're using an example of $1 billion there, but if you used $100 million, it's a huge difference. But like I said, very low-hanging fruit for Pennsylvania and a very good revenue maker to eliminate that vendor discount. Natural gas tax, the severance tax of 6.5%, did not make the final cut. The bank shares tax did increase, but it did not increase the 0.1% that the governor was hoping for, but it did increase 0.06%, and that's expected to raise $23.5 million for the fiscal year. That will take effect January 1st, 2017. Promotional plays did not make the final budget, and just what promotional plays are is a lot of casinos give away free slot machine play. In fact, it's estimated that 2.1% of all slot play in Pennsylvania is promotional play. So that would have an 8% tax on it, but that did not make it. But there were a couple of gambling measures that I did want to mention. One was 2% increase in the table games tax, which went from 14% to 16%. And that's expected to generate $17 million. And then there's about $100 million of pending legislation for online gambling. And that's looking like it could pass in the fall session. And Pennsylvania would actually be the fourth state to legalize online gambling. The insurance premium surcharge of 0.5% is obviously did not make the final cut. And then lastly there, the largest revenue piece for filling this budget gap was related to cigarettes and tobacco, specifically raising that dollar per pack tax for cigarettes was going to be $430 million, and then another 65 million on the other tobacco-related products. Key thing there is, cigars did not make the list, so cigars still aren't taxed. Go figure. Then we got some other budget provisions. One to highlight. I think the biggest one there is the tax amnesty program. This will run for a 60-day period, and that's to be determined when that's going to actually run. It's going to be before June 30th, 2017, though. So keep an eye out for that. The main advantage of main attraction of a tax amnesty program, that it would provide taxpayers or potential taxpayers a way of coming forward with their tax liability and only having to pay that and 50% of the interest. So penalties would be abated in full and 50% of the interest would be abated. And these would be referring to tax liabilities that occurred before December 31st, 2015. Sounds like a good thing. Pennsylvania gets revenue, and taxpayers are able to get out penalties and interest to some extent. But it was met with some resistance, and there's a few reasons for that. Some people in the tax practitioners and some of the legislators believe that it was too close to the last tax amnesty program, which occurred in 2010. Prior to that 2010 program, the one before that was 1995, so that was a 15-year gap. This has only been a 6-year gap since the last one. So it's not really, you're kind of rewarding taxpayers that aren't paying their taxes timely or correctly. It's not really encouraging out-of-state taxpayers, too, from filing on their own, because they can almost bank on potentially an amnesty program in another 5 years if they don't make this one. The other reason, or another reason for resistance, it's amnesty programs are just one-time revenue. It's going to, for the most part, it's going to speed up collections, but we're going to still have that gap next year. And then thirdly, a lot of the revenue is generated from taxpayers that have already been working through assessments or are potentially on payment plans. I think the idea of the amnesty program is to expand the tax base to include taxpayers that aren't filing. And it does do that to some extent, and that's where you can get the annuitized revenue. But oftentimes it's revenue from taxpayers already in the system potentially, and you're just speeding it up from one year to the next. And then the second point there, corporate tax report due date change. Just to give you a little refresher, back in the summer, I think one of the highway spending bills of all things, in that there was a provision that the federal return date would be changed for C corporations starting with the 2016 tax year, so think spring 2017 coming up here, that C corporations would now be due April 15th opposed to March 15th. And they'd be swapping due dates with partnerships, which were previously due April 15th. They'd be due March 15th, which would be in line with S corporations. And that's obviously, of course, for calendar year taxpayers. Pennsylvania has always been 30 days behind federal by law. So with C corporations, they were previously due April 15th. They will now be due May 15th. So yay for us. We have a longer tax season, Lindsay. Third point there, the budget removed the exemption for the personal income tax, or the personal income tax exemption for PA lottery winnings. And that's going to generate $15.8 million annually. And again, I would say when we're talking about low-hanging fruit, this is probably one of them. I don't think it's going to necessarily discourage anyone from playing the lottery, that they're going to have to pay 3.07% tax on their earnings. In fact, I think California might be the only state left that actually exempts its own lottery winnings. We talked about sales and use tax expansion, but they did also add a couple exemptions. One was for corrugated boxes, essentially adding that to the definition of cartons as it relates to an exempt wrapping material. And then harvesting timber is now exempt as well. We already talked about the table gains tax increase from 14% to 16%. And that's going to generate $16.8 million. And then the extension of a few credit programs, mainly the PEA Research and Development Tax Credit, past the 2015 tax year. There was also some other credits as well. The film credit was expanded. But there were a few new credits as well added that will take effect July 1st, 2017. I was looking through the list. There's actually 8 that I can see. Some of them are a little strange, too. There's the concert and rehearsal tour credit, the video game production credit, the coal refuse energy and reclamation credit, the waterfront development credit. There's a manufacturing credit, a rural jobs and investment credit, mixed use development, and then the brewers credit. So definitely our lobbyists at work there with some of those interesting, unique tax credit programs. And then $25 million more for the educational improvement tax credit program, funding for that program, I should say. Currently, or before this budget, the program had $100 million. It's a very popular program both for organizations that are receiving the donations and businesses who are making the donations and receiving credit for them. That program is now expanded to $125 million, so a 25% increase there. That money is going to be split among the 3 categories within the educational improvement tax credit. $15 million going to scholarship organizations, $7.5 million going to educational improvement organizations, and then $2.5 million going to pre-K organizations.
Mike, it looks like we have an audience question here, and this is going back to the expansion of the tax base. When will the tax on digital downloads take effect?
Yeah, that's a good question. I don't think I mentioned that, but it will take effect August 1st, 2016. Governor Wolf had originally proposed when he brought that to the budget that it would take effect April 1st, but that's not the case. It is going to end up being August 1st. And that's actually the same due date as well for the cap on the vendor discount. That will be applicable to returns that are due after August 1st of 2016 this year as well.
All right. So now going forward, what are some things not included in the budget that you see potentially being included down the road?
Well, we talked about it quite a bit now, personal income tax rate increase. In 2015, the governor brought a 3.7% rate to the table. This past year, he brought 3.4% to the table. What if he were to bring 3.2% next year? Would that be more palatable to the legislature? Maybe. If you look at our state rate, in and of itself, it's very low compared to the rest of the nation. In fact, it's one of the lowest. But you also have to combine the local rate in there. That a lot of states combine the local rate right into the state returns. PA, obviously, we all know is separate. So that definitely pushes the rate up to close to 5% for some localities, and even further if you live in Philadelphia or work there. Pennsylvania also does not offer as many deductions as the federal return or other states as well that piggyback off the federal return. And other things, you cannot combine losses from one category of income or loss against another income category. For instance, if someone had a flow-through loss from an S corporation, they can't net that against their wages income like you can for federal purposes. And also, spouses file on the same return for Pennsylvania, but they're not treated like a joint return. They're treated separately. So a loss from one spouse cannot net against income from another. So this really could push up the effective rate for certain taxpayers. And those are all things that you have to consider when you're talking rate increase for personal income tax.
Right. So really, even for a married couple, if one person has income in any category for Pennsylvania, that's taxed regardless of what losses are in any other categories.
Yeah, and I think some people are surprised by that too when they get to filing and paying their taxes that they weren't able to count on some of those losses. Sales and use tax rate increase. It wasn't on the table this time, but back in 2015, the governor proposed a 6.6% rate for the state. And if you look statewide right now, we're for the most part 6% combined state and local. If Allegheny County obviously has 1% or additional, and then Philadelphia County has a 2% additional. But most of the state is just a flat 6%, which is kind of right around middle to second half of rates if you compare them to other states. So that is one way that tax could be generated by increasing that sales and use tax rate a little bit.
So that's for the rate. Now, looking at the base, do you think wide sweeping changes to the tax base are likely to occur based on the difficulty getting those passed in 2015?
Yeah, wide expansion probably not, because when you're going after exemptions and exclusions, Similar to the federal level, when they talk about eliminating all the credits and deductions, itemized deductions, you're starting to deal with lobbying groups that specifically have gotten those deductions and exemptions in place. I think the one appealing thing to potentially expanding the base for sales and use tax is that it's a good way to generate revenue without increasing the rate of tax, because you're just bringing in more taxpayers and more transactions to be taxed. The fourth point there, corporate tax reform. This wouldn't necessarily be a revenue generator. It could be revenue neutral, but we'll talk a little bit more about how corporate tax rate compares to other states. But our C Corps pay the highest flat tax in the country at 9.99%, obviously just slightly under 10%. We have had some corporate tax reform already in the fact that capital stock tax has gone away, and after 2015 it's no longer around. But we're still not, if you're looking at that 9.9%, 999 C&I rate, it's very high. So the government in 2015 actually proposed that rate be lowered over a 4-year time period to 4.99%. But in order not to take a huge revenue hit, Pennsylvania would have had to actually institute a few other items. One would be combined reporting, which would essentially eliminate the Delaware holding company planning strategy. And another one is to restrict the NOL cap even more. Right now we do have an NOL cap, meaning that companies that have NOL are only able to use a certain portion of it against their taxable income, unlike federal where you're able to wipe out your entire taxable income in a future year if you had enough NOL. That cap is loosened up over the years, but it could get tighter if it could be more restricted if Pennsylvania did lower the rate for corporate tax. And then natural gas severance tax, that's been on the table for several years. Probably one of the reasons it didn't go through this year is because the industry as a whole has been declining, and it probably wasn't a good time to create that new tax on gas drillers, but I would not be surprised to see that back on the table in future budgets.
Well, that's the budget as it stands. We're going to stay in the mode of reviewing Pennsylvania tax updates and look at some legislation and cases that have come down over the past several months.
Thanks, Lindsay. First one's property tax elimination. That's Senate Bill, House Bill 76, the same number. Now, property tax relief sounds really good to the general public, and as a homeowner, I think not having to pay real estate tax would be significant savings annually for a lot of people. But I think that's why some legislators are eager to support it. But it even came within one vote of passing in the Senate back in November, and I think it had significant support in the House. It could have really become a reality. But there are a lot of negatives that go with that to replace that revenue. It would be an increase to the personal income tax rate by almost 2 percentage points there, increasing the sales and use tax rate statewide to 7%, and then sales and use tax expansion, like we talked about, to many different services and removing some of those exemptions that previously existed. And I think, in general, property tax, even though it sounds great, it's not. There's kind of a pretty big catch in this one. School districts, residents that were living in school districts with debt weren't able to take advantage of that property tax elimination, which most school districts do have debt. So it would be quite some time before a lot of the realization of the property tax elimination would take effect anyway. The next two bills, we already talked about, those were actually passed through the budget process. HB 1888 was a tax amnesty. We already talked about that. House Bill 1198, amended corporate returns. This was definitely a key one. Before, when corporations were to amend their RCT 101 corporation report, the Department of Revenue really had no statutory requirement to act upon that amended return. Even though in policy and procedure they typically were, there was just nothing that was forcing them to do that. So this codifies it and makes it a statute now that the department is forced to act upon or accept or reject a amended report within 1 year and provide written correspondence to the taxpayer about that. And both the taxpayer and the Department of Revenue could agree to a 1-year extension beyond that. The last one there is House Bill 561, and that did pass actually earlier in the spring. And that will take effect January 1st, 2016. It exempts all active military pay from local earned income tax, regardless of where it was earned. And that was previously the exemption that was in place prior to Act 32, which where most of us are probably familiar with. That came about in 2008 and took effect, I believe, in the 2013 year. But within that language of Act 32, it allowed localities to tax active military pay if it was earned in Pennsylvania. So this House bill essentially restores the old rule, making all active military pay exempt no matter where it was earned. So moving forward to case law developments, and this, some of these were very monumental cases that have come about from Commonwealth Court the last few months, and a couple of them were very, very taxpayer friendly. First case I wanted to highlight is one dealing with Pennsylvania's corporate net operating loss restriction, which we talked about briefly a few minutes ago. As I said, very few states still place a restriction on using NOLs, but PA is still one of them. PA's restrictions have been lightened a good bit in the past several years, but still currently a corporation can only utilize an NOL against current year income up to a maximum of either $5 million or 30% of taxable income. So to put this in real terms, if you had a corporation that had a $50 million NOL carryover and then the next year they had taxable income of $30 million, they could only use $9 million of that NOL in that current year. So they would still have $21 million of taxable income, even though they had enough NOL to fully to remove or negate the entire taxable income liability of that current year. For most corporations, this is not an issue because they would fall under that $5 million. Obviously, it's a greater $5 million or 30%, so they would fall under that $5 million piece. In fact, in the Commonwealth Court decision, they released a statistic that 98% of the corporations that had an NOL fell into that category in that year, which was 2007. For large companies, though, having a significant NOL and then large taxable income, it may take many years before the entity would be able to fully utilize that NOL with the current restrictions. So Nextel was awarded a $4 million refund for the 2007 tax year. They made the argument that smaller taxpayers are able to negate 100% of their liability, while Nextel and other large taxpayers are only able to negate a certain percentage due to having larger current year income, even though they had enough NOL to utilize it against the full tax liability. They argued that this violated the Commerce Clause, and they won, as I said, at Commonwealth Court, and it's currently being appealed to the state Supreme Court. Shortly thereafter that, and actually just last month, it was R.B. Alden Corp. Same issue, same decision, favorable for the taxpayer. It was a different year, though, just the year before, which was 2006. So it'll be interesting to hear what the state Supreme Court decides on these two cases. I would say there's certainly legal logic behind the argument that larger taxpayers are not being treated equally under the Commerce Clause. I think, unfortunately, though, this might end up hurting taxpayers in the end, both big and small. One of the judges in the Nextel case said that he agreed that the flat dollar limit of the NOL is unconstitutional. It's discriminatory against large taxpayers. But he said the flat percentage would not be. So potentially, coming from whatever the decision is at the same state Supreme Court, the legislature could change the NOL rule, taking away the dollar limit cap and just allowing the percentage cap, meaning that all taxpayers, both big and small, would never be able to negate their full current year tax liability with an NOL going forward. So we'll see how that goes. Second case there is the statute of limitations for refunds, which is the mission funding case. The way the statute of limitations for applying for a refund works is that you would need to apply for that within 3 years from when the date the tax was paid. For income tax returns, it's a little different than other taxes that are transactional in base, because income taxes, you might have estimates during the year. But the way the law reads is that it's based on the original or the due date of the tax report that you file, and that's 3 years from that date. And that's how the Department of Revenue has long interpreted that law. That's 3 years from the original due date of the return, and that's not including extensions. So in this case, though, Commonwealth Court said in its view, a tax liability isn't established until the filing of a return by the entity, because a payment of tax liability is not known or accepted by the taxpayer until he actually files the return. So this potentially does extend the statute for appealing for refund beyond the original due date of 3 years from the return original due date. for entities that are an extension. So again, this case has been appealed by the state to the state Supreme Court and is still pending. The last case there, the Local Tax Enabling Act, Fish versus Township of Lower Merion, this case is unlike the previous ones in that it definitely is not taxpayer friendly. In fact, I would say it's a little disconcerting to the taxpayer and business and practitioner communities. There's a statewide law right now that localities cannot specifically tax leases. Lower Merion, which is a Philly suburb, they interpreted that they are okay to tax leases as long as the tax is not specifically created to tax leases or discriminatory towards taxing leases. So I'll kind of explain that. They assessed a business privilege tax on landlords and brought suit against them for rental receipts for the, quote, privilege to be doing business in Lower Merion. So they did not believe that they were taxing a specific transaction, but really just taxing the overall privilege of doing business. Kind of a play on words, but I think that's what attorneys are good at. The legal counsel for the township compared it to a similar statewide exemption language, which applies to manufacturers. Specifically in that language, it says that taxation is banned, local taxation on receipts is banned for transactions related to manufacturing, on all transactions related to manufacturing. The same language for leases did not have that related to words in it. So Commonwealth Court actually voted against or made a decision against Lower Merion, saying that it was unconstitutional to tax these landlords on their receipts. But then it was appealed to the state Supreme Court, and the state Supreme Court won on a 3-2 vote. Also, I think it's a little concerning. It's definitely an overarching or overreaching of a locality in this situation to tax landlord rental receipts. And then the last specific Pennsylvania tax update was the Department of Revenue updates. And I would say the Department of Revenue has generally been somewhat quiet the last 6 to 7 months. They did release Corporate Tax Notice 2016-1, which is the add back of related party intangible expenses. And this became effective January 1st, 2015. And it's, like I said, the add back of related party expenses, most notably royalty expense. It was approved by the legislature back in 2013. So in effect, it was going to address the so-called Delaware loophole, which allowed certain corporations to lower their Pennsylvania income tax liability by having a related party, usually out of Delaware, charging them a royalty expense for holding their patents, trademarks, and intangibles. There were a couple exceptions, or a few exceptions to this add back. One was as long as it was a bona fide arm's length transaction, and that was in place for the agreement. And then 2, the principal purpose of the transactions could not be to primarily avoid tax. I think the practitioners and business community were definitely anticipating this publication. They were hoping that to kind of see what the department's position on these exceptions would be and if they could provide any examples. But if you read through this notice, I think it actually added more confusion and uncertainty out there. So we'll have to really see how this plays out in audits. Currently, a lot of Pennsylvania businesses, specifically C corporations, use an out-of-state holding company to hold their patents and trademarks for primary legal protection. As we mentioned, the rate for C corporations is very high at 9.99%, so this has definitely been an avenue to help lower that rate in previous years.
Right, that's definitely been a pretty common thing that we've seen here. And then the next update we have is the Airbnb agreement. For those of you who aren't familiar with Airbnb, it's basically an online marketplace where people can list their homes for short-term rentals. Well, now Airbnb has sort of partnered up with Pennsylvania so that they can become legal, and basically that means they are going to have to remit hotel tax. So Pennsylvania has a 6% hotel tax, and in order to level the playing field with hotels that are required to charge this, that's where Airbnb said, I want to be legal, let me pay the hotel tax. And it kind of just makes it a more legitimate business. Yeah,
you're right, Lindsay. I think that you've seen this in the marijuana industry as well, that these companies and industries, they want to pay taxes in those states because paying taxes really makes the state view them as a legal business. Unlike some other businesses that would prefer to avoid taxes as much as they could, these industries are actually seeking it out to become legit and mainstream.
Right, and I would almost say that that's sort of a requirement if they want to continue to grow the way that they have been. I think this has been a much more popular thing to do in recent times than in the past. So if we switch to two other cases, we're looking at online commerce here. So this isn't specifically to do with Pennsylvania, but it's definitely something that we'll have to keep an eye out for because it could certainly be affecting us in the future. So the issue here has to do with whether states are permitted to impose sales tax on out-of-state online retailers that are selling goods into the state through the internet, but don't necessarily have a physical presence. So we're looking at online retailers here. Similar to what has been going on with income tax, states are looking more and more at out-of-state businesses that don't necessarily have a physical presence and trying to collect tax on that. So if we look at these two cases, well, not cases necessarily, but Alabama has a new Bright Line Nexus standard. It requires out-of-state sellers with over $250,000 in Alabama sales, and that's online sales going into Alabama. It requires them to collect and remit sales tax on those sales. Similarly, South Dakota has a new law as well that's something similar. It requires out-of-state sellers to collect and remit the tax if the South Dakota sales exceed $100,000 annually or have at least 200 separate transactions. So they're saying without that physical presence, they want to be able to collect tax on those internet sales. The interesting thing about South Dakota is that the law that they passed allows South Dakota to sue any retailers that aren't in compliance with that. However, they're suing them so that they will be compliant. So it's not a dollar amount here or anything like that. They're going to sue you and then say, if we are successful, you need to pay this tax. Doesn't quite say that people are going to comply with that if that's the way they're going to handle it.
It's Lindsay, this is a really monumental shift in how taxation is going to be done. And like you said, we've seen this on the income side. But the Quill decision that came down in '92, that's kind of set the precedent that physical presence is required to be able to assess sales tax on a vendor doing business in the state. That '92, that was prior to the internet really taking off.
Absolutely, and that's the current standard. Actually, is the North Dakota versus Quill. North Dakota attempted to impose use tax on Quill for its sale of computer software to North Dakota customers. But in that case, the court ultimately determined that under the Commerce Clause, since Quill had no physical presence in North Dakota, it lacked that substantial nexus required for taxation. Now that's in complete contrast to what these states are saying now, is that we can tax you regardless of that physical presence.
And we've seen stuff in the U.S. Congress, acts that have been, and bills that have been out there, Marketplace Fairness Act, ones that are trying to level the playing ground with some of these big online retailers, or really even medium-sized retailers as well, that are doing business in many states but don't have a physical presence. I really don't think I think it's a matter of time before this becomes more widespread, and we'll see it in states that are actually closer to Pennsylvania.
Yep.
So then moving on to the third section here, how does Pennsylvania compare, and really in their tax structure, and how do they raise revenue in that tax structure? And we're getting a lot of these statistics from the Tax Foundation. They do a great job of analyzing the various taxes in states, and put some very good materials out there. And I think you'll find this interesting.
Right, so looking at this first chart here, this chart rates business climates based on a variety of factors. That includes the tax rate, the tax base, and the complexity of going through with those tax laws. So if you look at this, we fall in the middle of the spectrum at number 32, but there's clearly room for improvement when you're sitting at number 32 out of 50. On the next slide, as you can see, although we have a middle ranking, the tax ranking varies widely depending on what type of tax you're looking at. So our corporate rank, as you can see there, is extremely unfavorable, while our individual income tax rate falls near the top at 17. So Pennsylvania has the 15th highest tax burden in the country, with the percentages showing state and local tax burdens as a percent of their state residents' income. In 2012, Pennsylvania residents paid 10.2% of their personal income to state and local taxes. Now, this includes taxes that are paid to other states when traveling. So as you can see, Pennsylvania is the 15th highest there. So if we look at the corporate rank now, We're near the bottom with our really high 9.99% C corporation rate, with the only state rate that is higher is Iowa with 12%. However, Iowa allows a deduction for federal taxes paid, which can drop the effective rate down below Pennsylvania's. And in addition, Iowa's rate is marginal, so it's not a flat rate against all companies. So if you don't have a lot of income, you're not paying that 12% rate. If you're wondering why we are ranked 47th instead of 49th, being the second highest rate, it's because some states have a franchise tax, which PA, as Mike had said, got rid of in the 2015 tax year. Now let's put all of this together. When we look at where our revenue is coming from, it varies widely based on factors such as how the economy is doing that year. So the issue with a very high corporate tax rate is that although it provides a lot of funding when businesses are doing well, that rapidly declines when the economy is doing poorly because a business that doesn't have income generally isn't paying any tax. As you can see, individual income tax varies as well, but not nearly as much as the corporate because people still pay tax on what they're earning. So people can't live on zero income quite as well as a business seems to be able to do that.
Although I think some people try to report zero income, but it's usually a red flag under audit if you're doing that for a few years.
And, you actually see that with the sales tax rate here being the most consistent because people will continue to spend regardless of how the economy is doing. So you can see that that's the most consistent of the three. So where does PA receive its revenue? As you can see, personal income tax is by far the largest source with $12.8 billion in revenue. I believe this is 2015.
This is based on the 15-16 fiscal year budget, yes.
Sales and use tax follows not far behind with $9.7 billion. And then you've got other taxes at $10.2. And then C&I, which, again, surprisingly, although we have such a high rate, it's not one of the biggest revenue builders. So after that, we have gross receipts tax and the cigarette tax at 3.8%, which may increase, considering we've seen the budget increase from by $1 a pack. And then finally, the non-tax revenue at 1.6%.
So I want to close today by talking some about sales and use tax. Specifically, I put these slides in here and prepared this presentation a few weeks ago because I wanted to make sure we had some material to talk about with the budget. But I ended up taking a lot of them out because the budget actually did provide us with a good amount of information. So I'm going to go through this pretty quickly. I think we all know why sales and use tax is important for businesses. As Lindsay mentioned, for states, sales and use tax is one of the more consistent revenue sources, whereas income goes up and down. So states count on sales tax and use tax quite a bit, and it's one of the most audited taxes in the country, or across the country. Getting audited for income tax is usually not as bad because that could lead to a tax bill that you as a business would have had to pay regardless. However, if you're being assessed sales tax in an audit, that's a real shame because that's tax that you should have been charging your customer. It wasn't your liability. So you're essentially eating your customer's sales tax. So your margin that was 10% on a product potentially could be 3 to 4%, depending on even penalties, or even worse with penalties and interest. The next item is also key. It's sales and use tax is a trust fund tax. So corporate officers of an entity are actually personally liable, and it's been known that the Department of Revenue will show up to a corporate officer's home to provide an assessment if they're unable to get anywhere with the entity or by mailing the entity specifically. And the trust fund really means that the entity, Pennsylvania, does not view the entity as ever having ownership of the sales and use of the sales tax that they collect. It was their customers, they pay the tax, and the entity's just a vessel to getting it to the Commonwealth Court or to the Commonwealth. And then lastly, if your company's not aware of all the exemptions or taking full advantage of them, you're going to be at a competitive disadvantage with the rest of those in your industry. I think manufacturing is a good example. If you're not taking full advantage of the manufacturing exemption, if you're a manufacturer, your product cost is going to be higher, and ultimately it's going to price you out of the market, especially when you're talking in some of these industries that have much lower margins. And then use tax, that's just the inverse of sales tax. So if you're buying taxable products from an out-of-state vendor that isn't registered or doesn't have Nexus, as we talked about, or filing requirement in Pennsylvania, then you would be needing to remit use tax to the state at the same rate as what the sales tax is. I always recommend that every business should have a process in place for determining use tax that should be due on an invoice. So for instance, if no sales tax is charged on the invoice, also if the incorrect rate's charged on the invoice, I see vendors doing that a lot where they see the shipping address, but it's actually and they're charging that local rate for the shipping address, but it might be shipped to a different state, and it's actually, that's the jurisdiction that the rate should be based on. And then also, if you're ultimately buying a product and it's being shipped to Pennsylvania first, there's not a temporary storage rule, so sales tax should be charged in Pennsylvania. But if you're turning around and then shipping that to another division of your company in a different state, and that state has a higher rate, there's going to be a rate arbitrage that you're going to have to owe the other state. For instance, New York typically has a combined state and local rate of around 8%, so you would owe New York an additional 2% on that. So one of the main projects we perform for our clients is a process implementation and decision flow chart. This really helps your AP and accounting staff walk through the proper procedures for remitting and addressing use tax issues. And if we move to, and we talk about saving strategies and opportunities to save, I just had listed a few key ones on there. I'm not, for sake of time, I'm not going to go into all these, but you skip down to cloud computing, which is becoming quite popular. Even if you're buying software and using it on a server in Pennsylvania, it's actually, the taxability is going to be based on where your end users are. So if you have end users using it in a different state, part of it's going to be exempt. Landscaping and snow removal there at the bottom, I see that quite a bit. Lawn mowing is taxable in Pennsylvania, and a lot of lawn mowing companies turn into snow removal companies in the winter, and I see snow removal having tax on it all the time. So make sure you're not being charged snow removal. Second page there, just continuing that, the employee costs of health supply and building cleaning services. This is another place where I see vendors, cleaning vendors, not doing this correctly. The only taxable portion of cleaning services for offices is the service and markup charge for vendors in Pennsylvania. So make sure that your vendor is properly breaking out the employee costs from the service costs and only charging you tax on the service cost. Special resale, I think we're all familiar with the regular resale exemption, but special resale, as we said, Pennsylvania doesn't have a temporary storage exemption. So if a product's shipped into Pennsylvania and then you actually fabricate it or put that part into something else and then ship it to another division for use, you can get a special resale and actually have that exempt. So for sake of time, let's just move into reasons to bring in help. I would say it's difficult to master sales and use tax without constant or consistent experience. As we've talked about throughout the presentation, laws for taxes, especially sales and use tax, are always changing. And it's good to get a fresh set of eyes. Sales and use tax is very gray in certain areas, so having a resource to bounce an idea off of or get an expert opinion is definitely key. And one of the services that I recommend to our clients is that they have a sales and use tax review. It's a no cost, no commitment process for the client, so it really doesn't hurt to have us come in and take a look. What this would entail is that Lindsay and I would come in on site and review a sampling of purchase invoices, usually a year's worth, and then some contracts and intercompany agreements, as well as if the company had been audited for sales and use tax, we'd read their prior year audit narratives. We'd have a brief meeting with management, maybe even take a tour of the facility to kind of gain an understanding of the business operations, because we're looking for refund potential, and that's the main focus of what we're there for. However, we often will identify exposure items which you can identify to the client, and also offer best practices and tips and make recommendations. So even if we don't end up finding a refund or a refund's not available, I really think there's a value to businesses by having us come in there and do a sales and use tax review. And then in closing, there's a lot in our industry that do sales and use tax reviews. But this is a good way. Getting these refunds for them is a good money for them on a repetitive basis. As you can see on the illustration there, that means that their clients are continuing to pay representation fees every 3 years. I would always just recommend that you choose a representative that's proactive, and once they attain a refund for you through the appeal process, that they're actually assisting you in updating your records and identifying to you which transactions they actually got a refund for so that you can correct those, and also providing you exemption certificates to give to your vendors so that they stop charging you tax. At McConnell & Asbury, we do not view this as an annuitized revenue stream, but for your business, you should. These are one-time refunds, but they could actually present transactional savings for you well into the future without having to pay consistent representation fees every 3 years. So that concludes our part of the presentation for today. You've been a great audience. I don't think we've been heckled too much in the comment box there, which I'll consider that a good thing. With that, I'll turn it over to Tyler for closing comments.
Thank you once again for joining us for this presentation produced by McConnell & Asbury. We hope you join us for our upcoming events. You can stay up to date with news and learn more about our upcoming events by visiting us at www.macpas.com. Thanks again and have a great day.